Good morning, all. I hope you are well. So, this morning I have two pairs on watch, and those are dollar yen and Aussie Swiss. I literally just had to shut the window a moment ago because as soon as I started making this video, a load of birds, a load of pigeons started making a right old noise outside. So, one of the joys of live broadcasting or live making live content. But anyway, I have two pairs on watch, dollar yen and Aussie Swiss. I'm not necessarily anticipating dollar yen to be ready by the end of the day, but seeing as the market across the board looks like it looks like it needs a little bit of development, I've just put this on watch as a bit of a kind of an outside bet. Okay, so this is pretty self-explanatory, this one, if you've been watching my videos regularly. If you're not, welcome. This may not be self-explanatory to you, but if we look at this on the weekly chart, you can see that price is clearly coming all the way up, most likely to tap into this area here, this area of value, this standout area of value. We know that typically on the higher time frames, these standout areas of value that stick out like a sore thumb, we usually break above. If we're going to move to the downside, break above, catch people the wrong side of the market, as people that were involved in this buy position hold it because they think, what if it keeps going? So greed kicks in, so they hold the position that they'd previously planned to cash in at this area of value. So that's greed kicking in with a lot of people. When it breaks above, the news, the ticker, the brokers get hold of it and they say things in their ticker feed like dollar yen at all-time high or whatever high it is, and then that encourages FOMO, so people think it's going to keep going, so they start buying. You get the retesters, it breaks above, it starts to retest, people believe this is now support, so they start buying, and then you get this melting pot of people that are in these buy positions. And what you tend to see, I don't think I've touched on this so much, but what you tend to see is when we break above on the higher time frames, on the lower time frame, sorry, you start to see these little low momentum candles. Okay, so you often tend to see, I've noticed, candles like this. Okay, I don't know what's going on outside. Oh no, it's not outside, it's inside. It's my dog messing about. But you start to see these low momentum candles. When we break above, you start to see the low momentum candles, and that tends to give an indication that it's not the bigger players causing the move. So you'll see something like, if we use the bars pattern tool, you'll see something like that above here, and it will look more like that. And that's a good clue that this is not the big institutions. This is people just getting themselves caught the wrong side of the market, and then we tend to see the drop. So what I'm just looking for here is an outside bet, and literally the only reason I put this on watch is because, yes, we're quite far away from this, but we had this low test candle, bit of a wick above, so I wouldn't be surprised if this just messes about. But just because we had this wick here, this buying pressure, followed by a bullish close, I put it on watch just in case we kind of got what we're seeing now, this kind of morning star formation that takes us up to that area. You can see. And the other reason was we kind of had this structure. If we cut through this, if we assume that this is volatility, one of the things you can use is the line chart to determine whether something's volatility or not. If we assume that that's volatility, you can see that we have a 1, 2, 3 touch structure here. And when I did my forecast last night, I was kind of seeing, I thought maybe this is the retest of the back end of that. We then push up from there, break above, catch people the wrong side of the market, and then push down. We shall see. But that's what I was doing last night when I didn't actually use the line chart, but I was just when we see a wick like that, something which looks out of place within a structure like this is usually just volatility. And if it's a wick on multiple time frames, as you can see it is, it's a wick on the daily, the 4 hour, the 1 hour, and even on the 15-minute, that's usually not indicative of the sentiment of the market. So all I'm looking for, quite simply, to cut a long story short, is I'm looking for a break above. Okay, I'm looking for a break above the area of value because it's a significant area of value. Usually we will break above these if we're going to move to the downside. A break above followed by a break back in. It might not be quite as big as this, but if we just go to the 1 hour where I did the forecast, I'm looking for a break above, a break back in, a 1 hour impulse back down below the area of value, and then I'm looking for a 3-touch 5-minute continuation or a 2-touch 5-minute continuation with a 3-touch structural approach. So once we've got the 1 hour impulse back down below the area of value, what I will be doing is I'll be looking for a candle to close green. So obviously the impulse down will be red. I'll be looking for a candle to close green on the 15-minute chart. And then once it has, I will drop down to the 5-minute chart to look for 6 to 8 corrective 5-minute candles. And then I will get short on the break like this. If we get what we might get is if we break above, break back in, and we get a 15-minute consolidation. So if it just consolidates for longer and longer, and then the consolidation ends up being we start to see a green candle close on the 15-minute chart, we might get a slightly larger continuation, not a large one, but a slightly larger one. And I would do the same thing again. I would get short on the break, but in this instance, so if it was 6 to 8 corrective 15-minute candles, I would also be looking for the entry within the flag if we got the 3-touch structural approach, which taps into the initial high, okay? And then I would cancel the original order that I had on the break. But one of the reasons we keep the original order on the break is because we don't always get the preferred entry, and then price sells off, and then you end up missing this entry, okay? So in this instance, we would have something in the region, literally just down to here, okay? I would be targeting that low. The reason I would be targeting that low is, on the higher time frames, it's visible on the 4-hour chart. It's not necessarily that visible on the daily chart, but this wick is. This wick alone is where I would anticipate after such a big move like that, given that we're on the daily chart, is where I would anticipate some profit taking. And the other clue for me is the fact that even if we were going to continue to the downside, okay, the other clue for me is that what did we do? Yes, this is a volatility wick, but what did it do? It near missed to here, okay? So that gives me a clue, especially when this is quite a bit of a sharp move. So we have a sharp move down there followed by a sharp move up, and then even though this is a volatility wick, it near misses to it. When we near miss to an area, that implies that area is valuable, okay? So if it's valuable, it's probably going to be an area where we see some consolidation for a period of time. And what we know, if this is the range, is that if price pulls back from this area, it usually pulls back about 90% of the range, even if it is going to continue in the forecasted direction, which would mean that I would have to hold through a correction which is potentially like this large. So we'd get something like that maybe. It might not necessarily be, structural like that, but that would mean that I would have to sit through a pullback of approximately 5%, 6%. So it's just about not giving back too much profit, okay, and not sitting through these massive pullbacks. One of the reasons that we trade the way we do is so that we don't spend too much time in the market, because the more time you spend in the market, the more exposed you are to slippage and all kinds of news-based volatility. So in this instance, I would have something in the region of 6% to work with to that low there, obviously dependent on the size of the stop loss. And then down to these lows, we would have something in the region of 10% to work with. Okay, so a 50% pullback, if you do the maths, would be, about a 5%. You'd have to sit through a 5% pullback. And then what I would do is I would set a take profit at the 90% area, which is just above that wick, which is likely where price will pull back deeply if it is going to. And that would give us something in the region of 9.2%. Okay, so I'm not looking for massive home runs. I'm looking at the structure, and I'm looking at where can I get in safely, and where can I squeeze as much juice out of the orange without greed kicking in. Okay, so that's what I'm doing. So we have an alert set there. I'm just going to move that up a bit because it's a bit low. Right, there we go. So that is dollar yen, nice and simple there. That's one of my reasons this is my favorite, is because we would be positioned extremely well. We would be high up in the run if we got that entry, break above, break back in, flag, very high up in the run. Okay, the sequence by that point would likely be very good, because that would be likely be the first flag. So anyway, that was dollar yen. So Aussie Swiss is pretty much the same thing I was looking for yesterday. It has broken above. Okay. Now, if we just zoom out, what has this become? This has become a higher time frame liquidity point. So if it's become a higher time frame liquidity point where there was a sharp move up, sharp move down, it's more likely, if we are going to move to the downside, that we will break slightly above before moving to the downside. Okay. Because for the reasons previously given. Let's just measure this. If we measure this, we have broken back, pulled back just over 50% of the entire range. I have noticed with corrective pairs such as Aussie Swiss that if we are going to move to the downside, we do tend to pull back slightly more. It often tends to be a bit of almost a 60% pullback sometimes. So that's a observation. Is there any reason at this moment in time for price to be pulling back here? Is it coming up to test here? Well, it could be, because, which is one of the reasons I'm waiting for the push down and the flag, because this is more of an, yes, it's sharp, but it's more of an inflection point. And I am mindful of the fact that this, okay, is a near miss to here. So as I said previously, it could be the case that we come up to give us this kind of structure. However, because we don't really have, we do have a bit of a middle section here, but what I would anticipate, what would be more likely, is a move down to here to take out that low, to give us that middle section, to then take out that high, which this high near miss too. And also, if you just look at that inflection point there, that would then give us that kind of structure, okay, which would likely be the volume required for price to come all the way up to there. Okay, so, and for that middle section structure to form, one thing I was thinking of yesterday when I was doing my video is that if this structure would be parallel, okay, so we've got, then this might break slightly above before moving to the downside to give us that parallel structure. And also, we also have an element of a left shoulder, head, right shoulder. And what we know about these head and shoulders patterns is that often the right shoulder will supersede the left shoulder, or at least equal to it, before price moves to the downside. So I was factoring that in yesterday. So we might just be blasting to the upside. And if we are, I'm just going to take this off a watch. As I said, I'm not interested in being right. That's not what I'm doing. I'm trying to manage risk. How can I manage risk? I know in the past, people have watched my videos and they've said things like, oh, you've made me money, you've lost me money, it worked, it didn't work, etc., etc. That's not what I'm doing. I'm not, both of those comments are about people trying to be right. Now, I couldn't care less about that. It's not being right that makes you money. Within about a month of trading this strategy, I was able to pick the direction with a fair degree of accuracy, well, with a very high degree of accuracy. But it's actually the timing of the entry that makes you the money. It's not being right or wrong that makes you the money or loses you the money. It's timing your entry in such a way that you can manage your risk. Okay, so if we just zoom down, so we're now at the area of value where there was a sharp move up followed by a sharp move down. Another reason why we might be pushing a little bit higher, if we are going to move to the downside, okay, is because one of the things I was looking at this morning is we kind of have all of this structure, okay, and then we break the structure impulsively. So we break through the brick wall low, and then we leave a bit of a footprint, okay? Often these footprints, which fall 50%, which are like a 50% pullback of a move which broke a structure, often and especially if you look what happened here, there was an exchange of liquidity that caused price to completely smash through this low and completely break out of this. So this may potentially be an area of value here. I just haven't got it marked up as an area of value because it's not as standout as this one. But what this high is a near miss to this high, which was a sharp move, which caused price to completely smash to the downside. So there may be a lot of liquidity here. So what we might be doing is we might be moving a little higher to take out this high, which this high near miss to, which would make sense because of that dropout, which broke out of all of this. Okay, so what I'm going to be looking for with all of that in mind is I'm looking for a break back below here. You can almost see where the sellers got caught in too early here. People started to sell, they get washed out. This may be what we call turtle soup. or some people call turtle soup, where people sell here, they get washed out, and then it moves to the downside like that. And also, as I said yesterday, if we measure where price started to impulse, okay, actually we can measure that from there now, I suppose, because where did it start? So we may push a little bit higher, okay, because you can see we have an impulse correction continuation here. So I'm measuring where price started to impulse. I'm measuring the start of where the correction finished, so here, and then I'm measuring where price started to impulse up, so about there. So we may push a bit higher, okay? But what I'm looking for, regardless of whether we do or whether we don't, I'm looking for, as I said, nothing happens all of the time and nothing happens none of the time. So what I'm looking for here is I'm looking for a break. We've got the break above now. We may be catching people the wrong side of the market because this is high. This is now a daily liquidity point, daily area of value. I'm looking for an solid impulse back down, followed by a 3-touch 5-minute continuation or a 2-touch 5-minute continuation with a 3-touch structural approach. Okay, the 5-minute or the 15-minute continuation, and then I'm looking to get short on the break of a 5-minute or a 15-minute continuation. And if it is a 15-minute continuation, I would also look for that entry within the flag, and I will be able to manage it down to this the start of all of this consolidation, something in the region of 2.5. So I can manage it down to there. Okay, if we get what I'm anticipating, and then my target in this instance would be down to here. Okay, and because of, as I said yesterday, I wouldn't necessarily be targeting down here, partly because this is a wick, and even if we take it to there, we do have a bit more percentage to work with there, but I'm kind of seeing this as potentially the middle section within this move to take out this high, which this high near missed too. Okay, so because of that, I'm happy to take a kind of shorter term trade. If we'd already, for example, if we'd already tapped into that high and we'd reacted from there and we were down here, then I would probably be targeting, maybe not this wick, but I would be targeting, because that's likely just volatility, but I would be targeting perhaps that low there, because if we measured this where price started to impulse, we measured the start of the correction, and we measured the range from there to there, that would almost line up bang on with that. So that would make sense. But just a shorter term trade, as I say, I'm not interested in greed, just interested in managing risk. That's it. So what I've done is I've set an alert just below the area of value because we've tapped into it now. So now I'm looking for the impulse back down. If that alert does not trigger, then obviously we haven't broken back below this high. So that is Aussie Swiss. I hope you've enjoyed this video, folks. When I have less pairs on watch, I try to go into it a bit more detail, because when I normally make these videos, I can't, not all of the thought process. A lot of what I'm doing is subconscious. Okay, so I'm not even thinking about it, because I don't have to think about most of the things I do now. But when I've got less pairs on watch, I can go into a little bit more detail of the thought process that happens often at a subconscious level. Okay, and that's just experience. Now I'm getting more experienced. Still got a lot of years and a lot of things to put under my belt. But I've learned a lot in the 5 years that I have been trading, and the 4 years, over 4 years now that I've been trading this strategy. Anyway, I hope you've enjoyed this. I will, of course, update you if I place any trades, but have a great day for now, and I'll see you again in the next video. Thank you very much indeed for watching.